I want to maybe just start off, if I could, almost like a funnel. We'll start with the big picture, see, and then kind of just bring it down to understand what it means eventually for Canada and for the markets. But Beata, I'll start with you. This was, I think we can say, more decisive than expected in terms of some of what the polls were saying. What is just your initial take on what this means? And then we'll get into it.
Well, the decisiveness is good, and you can see there was quite a strong reaction in equity markets as a reaction to it, as well as the currency movements on the US dollar has been positive. And bond yields have also been priced higher on the concern that we're going to have higher inflation, which gets to what it could possibly mean, which is it's a stronger mandate to press forward on the tariff front for Trump. He was going to do it anyway, but certainly it helps when you have pretty strong control of the Senate as well. We'll see what happens with the House. And so I think markets are saying we're going to be in an environment where it could be net positive for corporations. However, at the same time, a slightly higher inflation environment is the risk factor. Probably higher deficit levels than previously anticipated, and you see that coming through on bond yields.
Kevin, same general question to you. I mean, we have the reaction, as Beata mentioned too. I mean, we don't know the House yet, but it gets all of Congress. That's even different too.
Yeah. So markets are pricing in 90% probability of a sweep, so that they do get the House as well as the Senate and the presidency. I think to some extent it's traditional GOP economic policy. So tax cuts, small government deregulation, and I think those are going to be important themes in markets. But there's also a twist, and this is a twist we've seen from Trump since 2016, that is an emphasis on tariffs and industrial policy. And I think the reason driving that, we have a chart up that shows the labor share of output. This is a record low, and two of our key themes over the last 8 years, investment themes, have been globalization, how that's being reinvented, and also digital tech AI. And they're hurting a lot of workers. We're seeing increased income inequality. And I think a lot of people, particularly outside the big coastal cities, outside the liberal, well-educated elites, they're not feeling great about their future. Real income growth has been quite weak relative to history. And there's a lot of concern. And at least the GOP appears to be talking to their concerns. Whether their policies will actually help them or not, I think, is a different question, but they are being acknowledged.
I want to even just touch on that, because we were talking about this earlier too when it came up. So what the chart was showing was just that there's been lots of output in the world, but the labor participation in that in the States has been dropping. But part of that is that tariffs and trade policy, or is it, I know you talked about, is this productivity?
That's part of their productivity story and their outperformance. One of the interesting factors is we know that in aging demographics, you're going to have less labor input over time. And so you have to get better on the frontier of efficiencies and productivity. And the US is a bit of the poster child of this, that they're able to do it, to the point that there is inequity. We've heard the story and we've seen the results for a long time. It started many years ago under manufacturing and the shift to globalization in terms of automation displacing workers, and now the concern is that AI will continue to press even more so on that channel. However, much of the inequity is really, in terms of the US, a function of their tax policy system and the distribution or lack of distribution of income from wealthy over to middle and low income individuals, and they don't have that same social net that you see in other countries. So there are policy decisions that are a direct outcome of the inequity that they're facing, because automation is a global phenomena, AI is a global phenomena, but the US has the greatest amount of inequity between their high and low income individuals.
Interesting. Okay, I've got a long list of things I'm going to throw at both of you in terms of what I've heard that could be coming. You can tell me, and I just want to stick with the AI because Donald Trump has repeatedly said he wants to make the US #1 in AI, and he's got a guy named Elon Musk right beside him, which doesn't hurt. What does that mean? What do we think that means?
So immediately, the Biden executive order on AI, that gets dished aside. So that is totally gone. There's a
and that was encouraging more regulation in AI,
yes,
is it not?
Yeah. So soft regulation, certainly nothing like the EU, but some degree of regulation. So that's gone. It's a green light for AI, for building out foundational models and doing different things. Also, I think in terms of antitrust, we've had a very aggressive antitrust enforcement under the Biden administration. Currently, 43% of the S&P by market cap is under investigation by the FTC. This gets dialed back, say, from a 9 towards a 4. It gets dialed back. So we are going to see more acquisitions of big tech companies by startups and smaller tech companies. And part of this will be given a national security reason. That is, we have to be ahead of China in AI. This is very important on a bipartisan basis, but particularly, I think, to Elon Musk, Donald Trump, and the Republican Party.
Okay, I'm going to sound like I'm taking a lot of left turns here. I just want to, because there's a lot, you know, I think, and there's a big reset, I think, that's going to be coming. And so if we think about, you know, AI, I know is a priority, but we'll go through maybe tariffs and taxes. Tariffs. Yes. So he has said very publicly he plans on slapping huge tariffs on China. We're still waiting to understand what it could mean for Canada. What are you listening for?
Well, there's a lot of speculation that first of all, absolutely he will follow through with tariffs. There's no question on that. Where the uncertainty is on the amount of tariffs and how fast and how broad he goes across countries. Because the risk is you destabilize your own supply chains and corporate profitability by, you know, just doing big, large blanket policies. So there's a lot of speculation how much of this will be some degree of negotiation tactic. For example, on date X, you know, inauguration is what, January 20th, so on January 21st, we hear, like, here's the pain points, here's the countries of interest, and here's the targeted tariff rate that the US is after, but you have until date X to resolve, come back with something. This can't be the whole strategy, however, because they have a lot of tax initiatives that are very costly that are coming through, right? Just even maintaining the TCJA tax cuts is a very expensive proposition, and they absolutely need revenues. So they need those tariff revenues to pay for the tax cuts that they want to hold in place. While they don't offset the tax cuts in terms of the expense of it, they're going to need something. And I know Elon Musk is one of those folks who's out there saying, hey, I can find a couple of trillion in savings over the next 10 years, but that is a process and it takes time. So we will see some tariffs come through. It's believed that Canada may not be the first target of their interest. Europe will be, China will be, and Mexico's probably feeling pretty nervous right now because they're often used as a conduit to get Chinese products into the US. So I do think Trump will take a hard line with them probably earlier than many are anticipating, as trying to cut off that channel. And then I think we have to see where all the chips fall. So ultimately, the way we're thinking about it is you end up with slightly slower global growth trajectory, slightly higher inflation trajectory, and then how that gets pieced out by countries depends on where he goes with the tariffs by countries.
Yeah. I'm going to jump, just because I said we want to get through them all. Taxes. You know, this is something that I believe all of Congress needs to weigh in on if he's going to make a change on taxes. But you know, he wants to cut. He's talked about, I mean, I've lost track. I mean, there's tips and there's whatever. There's all the other things too, and extending the tax breaks you mentioned before. So what are you listening for there?
So definitely an extension of the tax cuts from 2017, and then potentially changes on Social Security and tips, making them tax exempt. We don't know how this will go. Just one quick comment on tariffs, because there is a lot of uncertainty. It's going to be transactional, but we do know that its primary focus is China. We've seen that from Robert Lighthizer book, his interviews in The Economist. We know a lot of details about what they're going to do. So there are going to be tariffs on China. It's going to happen quickly. Canada is not in the top 10 list of countries in which Trump is concerned. And so it won't be in the first or second round, but there are a number of issues. And the other thing with tariffs is a lot of economists are very negative about tariffs, but positive about industrial policy. And we can see because of globalization, AI, we do need industrial policy. But in fact, tariffs are a type of industrial policy. And one can argue about whether one's more efficient than the other, but they're going to go together. And from the GOP, we're going to see different types of industrial policies. Biotech is up next. The CHIPS Act is very important. The IRA, which is focused on green energy, that's going to get dialed back. But tariffs and industrial policy are a big part of what the GOP is going to be focused on.
And I guess the knock-on implications for Canada and all this too, when you're trying to attract investment and trying to get people, you know, get more here. If someone to the south is looking either less, more attractive, because all these things are happening, that has a real knock-on effect for us.
Yeah, and you saw it in the market reaction. We saw the currency, the Canadian loonie, drop slightly on Wednesday morning, just reacting to the news. You know, we have seen our bond yields rise about half as much as what we're seeing on the US side, so we're importing some of that outlook on the inflation side and some of the risk premium that's getting priced in. Ultimately, there's nothing positive with a Trump presidency and administration for Canada. It will be net negative in terms of more pressure on trade in free trade flow. But that creates, I think, was saying, like, basically there's a difference between how you view the next 12 months and how you view the next 5 years.
Yes.
And so the adjustment on the tariff side is really a 12-month outlook. So when economists are negative in terms of the economic growth impacts, what they're typically thinking through is you have an adjustment period where the tariffs come in, so the price level just rises. Companies are highly adaptable, and they will resource, and they will move their supply chains, and they will adapt, and there will be substitution of products. So this happens over the course of beyond that year process. And that's when you get more into different phases of the negative impacts start to move away, and the industrial policy becomes more evident in the data of how you're bringing back production. And the Chips and Science Act is a very good demonstration of that, of how much production the US was able to bring back in a very short period of time. One of the things that it could do for Canada, on a positive side, but in an odd way, is that we are constantly in reaction to the US domestic policy and tariffs. And it may press governments in Canada to really come up with better design on corporate tax policies and incentives here, so that we're not always in reaction mode.
Yes.
And we are, really trying to be front runners in the space, as opposed to just reacting to what we're seeing south of the border.
Talking about inflation, interest rates, because at the bottom of all of this is all very, at least the market's interpreting, the tariffs are good for inflation, I mean bad for us, but also it seems somewhat growth positive too. All these things are inflationary.
Yeah, so what we're seeing effectively priced is you're going to probably see inflation in the event that Trump does that blanket 10% tariff and potentially 60%, maybe less, but whatever it is on China. Many people place the estimate that inflation rises between 50 basis points and 100, so a full percentage point increase from your counterfactual. That holds for about a year, and then as long as the tariffs don't continue to rise, it just starts to back off the data. So, and this is why it's a level price shift, but then, as time continues, it kind of disappears. From the Federal Reserve's perspective on interest rates, how do they internalize that? Well, typically a central banker will look past a shock because it's not necessarily a demand-driven factor, it's a policy-related factor, and because it may not have longevity. And so what we think it could do is slow down their pace of rate cuts, but not necessarily stop the whole process. And you see that pricing in the markets. If you look, I think it was 2 months ago, markets were expecting the terminal rate, the end point of interest rates for the Fed funds, to be at about 275 by the end of next year, and now that's up all the way up to 377. So even now markets are saying, yeah, we think you can still cut, but you're not going to be moving at the pace we thought you could have moved a year ago, or 2 months ago.
Yeah.
On which issue? I'm sorry, Kevin.
Well, I guess inflation, but I was going to say, what do we see of inflation, but how does that get translated into rates, and what your thoughts are there?
Yeah, so we have a chart that shows the correlation between the probability of Trump winning and the 10-year bond yield. And it's had about an 80% correlation over the last 4 months or so. And this has continued through this week with the 10-year yield up 18 basis points. And we think in this environment, as Beata was mentioning, we're going to have higher deficits, potentially stronger growth, pressure on inflation. And we definitely have a president-to-be who doesn't care about the deficit at all, thinks that stronger growth will pay for the tax cuts. So I think everything about this says higher inflation, higher interest rates going forward.
When does the market start to care about that? The deficit size? I mean, I know we say that yes, and there's ceilings, then we get through them, and I mean, from a safety of the greenback, I guess is what I'm asking.
It seems that bond markets haven't cared about this since the 80s when we had the bond vigilantes, but since then we've had a long period in which the debt and deficits continue to increase and bond yields keep going down. And at some point, the markets will force a reckoning, but there's no reason to believe that's happening now. And as long as the world is flush in cash, and it does appear to be flush in cash, this can run for a while. And I think that's why both candidates had very irresponsible fiscal policies, promising higher and higher deficits and higher debt levels, even when we have unemployment at 4.1%. So Trump sees this message, and there's a lot of spending, there's tax cuts, higher deficits, inflation, higher interest rates.
Yeah. And I'm throwing things again. There's a lot going on we're trying to digest, but even you think from a foreign policy perspective, I'm just thinking about spending, deficit spending, military spending. That's not going away anytime soon. Like we're still waiting to see what's going to happen on the foreign policy front, but I think the world expects something to happen, and that's going to have reverberation too.
Yeah, so we already saw in the latest GDP report out of the US that defense spending was sky high. So, you know, it's a continuation of that. We'll see. There's talk about, you know, Trump doesn't have a lot of patience for foreign affairs.
Yeah.
And so will he force a resolution between, or try to force or negotiate a resolution between Russia and Ukraine? We'll see. You know, Israel, we don't know. So, so it's possible it could actually go the other way if he gets something resolved on that side, if he helps to broker a deal.
Yeah, yeah. Thoughts?
So the degree of geopolitical uncertainty is the greatest it's been since at least the early 90s, with the Middle East, particularly Iran, Russia, Ukraine, and China and Taiwan. So globally, defense spending is going up. In Europe, ultimately in Canada, it's going to have to go up, and I think that'll be accelerated. In the United States, I think there will be increased defense spending and a real change in the way defense spending takes place. And you mentioned Elon Musk before, and whether it's going to be drones, autonomous vehicles, increased use of AI, hypersonic missiles, I think there'll be a real change in how we think about military capabilities. And so much of this is ultimately to make sure that we're a generation ahead of China. And that's incredibly important to DC.
And you brought a chart with us to talk a bit about what has happened and also the difference you think between rhetoric and what actually happens.
Okay. So this chart shows what happened to the S&P and the S&P sectors in the 12 months after Trump won in 2016. And so you can see the equity market had a very strong run, up 20%. We think it's going to be closer to 10% this time, so still strong. But if you look at the best performing sectors, tech and financials, we think we probably get a rerun of that. And then there's a couple of sectors that will have headwinds, either from the tariffs or from imports from China and the supply chain being challenged, as Beata was mentioning. So particular consumer staples and consumer discretionary having challenges from that. The other point to emphasize in this is, despite Trump's rhetoric, which sometimes is a little bit extreme, his economic policies and his appointments tend to be very conventional GOP. That was true in the first round with his Treasury Secretary, Steve Mnuchin, Trade Rep, Robert Lighthizer, and so forth. And we think that's likely to be the case this time as well. Pretty conventional, accomplished people who actually are very policy focused, and we get quite good economic policy out of this.
Okay. Beata, what's the big takeaways for Canada?
Yeah, so Kevin was saying we get good policy out of this. I think the U.S. gets good policy out of this. And I think the takeaway for Canada is to really push through on how could we have more business-friendly policy in Canada for domestic players, as well as attracting foreign capital. This has not been a strength for Canada, and in fact, we've seen more businesses closing than opening in Canada, so the degree of dynamism has worsened. So we really need to turn the dial on that, and if that means it's because the U.S. is getting better policy, we need to think through what that looks like for Canada. In terms of what the U.S. is doing, it's on net, it's negative for the Canadian dollar unless we find our pivot point in terms of competitiveness, not just relative to the U.S., but to Europe and others. And so, you know, it's quite possible that we know we can, the dollar's flirting in the 71-cent range. If the Bank of Canada has to cut far more than what we expect out of the Federal Reserve, that spread widening could put the Canadian dollar in at 68, 69-cent levels. So we haven't seen that in a while. We are already hearing quite a loud voice from corporate Canada that this is a little bit painful for them, because much of our machinery and equipment is imported product, and a lot of that is from the U.S. So while on the one hand you're trying to stimulate the economy, you also have a counter influence of making investment more expensive for those who need to import their equipment. And so there's a little bit of a dance happening there. And so I think those are probably the two biggest aspects. And then of course, as Kevin mentioned, we're likely to see more spending in defense that will be compelled out of the US, probably needed anyway. So we may see some fiscal deficits that are a bit larger than we had anticipated prior.